Okay, without further ado, we shall start our session today. So today we're going to talk about day trading strategies, and today's event is presented by PU Prem. So before we start, allow me to read out the disclaimer for today's event. Today's Market Insight webinar is intended for educational and informational purposes only, and participants shall not take it as financial or investment advice, nor a trading signal. The accuracy and reliability of the information provided cannot be guaranteed. PU Prime and I hosting the session are not liable for any losses or damages resulting from the use of information presented today. Participants are responsible for independently verifying information and considering their own financial goals and risk tolerance. Okay, this is the disclaimer for today. So without further ado, we shall begin. This is what we are going to cover today. So I will briefly discuss some of the basic candlestick pattern. And of course, after we learn about the candlestick pattern, we'll apply it to some of the short-term strategies. And of course, most importantly, after we learn all this, it is very crucial for us to learn about risk management, because after all the tools and we equip ourselves without a very good risk management is almost to say equal to zero. We don't know how to gain profit. We don't know how to stop ourselves from greater losses, right? So let's moving on. So before we learn, we learn about candlestick pattern. We have to know what is candlestick. So candlestick is from Japan. So before it used in the financial market, before we use it for technical analysis, it was used by the Japanese in the markets when they sell agricultural goods and also seafoods. They use it to mark the price. So if you look at the picture on the right side, this is how the candlestick can look like. And of course, we know that there's other things that we can use beside of using candlestick, but it is very, very popular nowadays. Of course, just let me show you. We have other things like bar chart, and also we have like line and etc. But I would say at the moment, I still find the candlestick is very useful. And just briefly introduce you how can we look at a candlestick and then what it consists. So when you first look at a candlestick, there's consists of four things. The first thing is the opening price. So we have one opening price, and then the next one is the closing price. And of course, you can notice that there are wick from the upside and also the wick from the downside. So these are like the lowest point as well as the highest point. And so how can we differentiate between the bullish candlestick and also the bearish candlestick? So we have to compare the opening price and also the closing price. So when the closing price is higher than the opening price, this is, we call it a bullish candlestick, right? It makes sense, right? So let's say the Apple stock from $1 up to $2. So it means it's increasing. So when it's increasing, it's like a bullish trend, so going up. So we call it a bullish candlestick. Vice versa, if the closing price is lower than the opening price, we now have a bearish candlestick. Right, it does also make sense. Let's say Amazon, from like $5. After that, at the end of the market, it closed at $4. So it decreases. So when the closing price is below the opening price, we got a bearish candlestick, means the price goes down, right? So this is how we got the bullish candlestick and also the bearish candlestick. And of course, you notice that we have the wick. Wick is called this like this stick or this tail at two sides of the candle. That's why we got the name candlestick as well. And what does it mean? So the wick on the upside, we call it like the highest price of the time frame. And the wick at the lower part will be the lowest price within the time frame. And of course, if you are trade for times already and you are very get used to the technical analysis, well, of course we know that we have like different time frame. We can have like 1 minute time frame, 3 minute time frame, 1 hour, 2 hours, 1 day, 1 week, 1 month, you say so. So this means that if let's say we have like a 5-minute time frame, so these prices are just for within that 5 minutes. The highest price of that 5 minutes, the lowest price of that 5 minutes. And if this is like a daily but candlestick chart, so it will be like the highest price of the day, lowest price of the day, opening price of the day, and closing price of the day. Okay, so this is briefly what it is. It's very useful and also it's very simple. And after you know, if you arrange it across a bigger picture, you can get a a bigger picture of what trends are we trading now, regardless of what asset class we are trading. So moving on, I will introduce you several candlestick patterns and also the logic behind it, and different candlestick pattern will tells you different story about it. So first of all, the first thing that we want to see is the doji. So doji, this word is also derived from the Japanese word. So we don't need to know more about it. We just call it doji. How it look like is like a cross or a plus sign. So just now we talk about the closing price, we talk about the opening price. So at here you can see that the close price and opening price is very, very close. It's almost like cannot see, or almost like not changing. So when it happened like this, what does it mean is the market has already in dilemma. They cannot decide what price they're going to be, what direction they want to be. So, and also doji is very important on how we use it. Normally we don't use it in like middle of the trend. The doji only have it meaning when you can see it in a very aggressive either downtrend or uptrend. And when it appeared on the peak of the uptrend, or when it appeared at the lowest of the trend, true, it means that there might be a chance that the asset price, the price of the asset class might have the chance to change, might have a trend reversal. Yes, so this doji candlestick serve as a potential trend reversal signal. Okay, so the key point is this one. It's only very, very useful when it appeared at the support or resistance level. So before you want to use it wisely, we always have to train ourselves to get the best support level or the resistance level. And when it appeared on the certain level, on those levels that we draw, it will be very useful. It just tells us that, yes, maybe we enter here, we can catch the entire new trend. If it appeared on the peak, we can catch a short position. Let's say now gold price is reaching above like 1,875, let's say, and it have this doji candlestick, and maybe we'll think that, oh, maybe this is the chance that we can catch a downtrend from now, and and then we can open a short position, and then hopefully the gold prices will continue to trade go down, right? And it's the same to the opposite. Let's say now the dollar index DXY maybe now currently is at 106, and we know that previous 2 days the dollar index has been trading downward. So when this doji candlestick appeared at the lowest level, we can expect it that this might signal a trend reversal, and then we can open a long position, and hopefully the dollar index will rebound from there, and we can catch a rebound, a technical rebound, right? So this is how we use a doji candlestick. And moving on is the hammer or inverted hammer. So this the pattern. If you look on the picture of the right, you can see that it just look like a hammer. So you have a very long wick on one side and a very, very short wick on the other side, and the body has to be very small. Okay, it just look exactly like a hammer. So regardless it is like a hammer or an inverted hammer, so if we see this kind of price pattern or candlestick pattern at the bottom or at our support level, it will just tell us this might be a bullish candlestick. It might have a potential bullish reversal. So because dodgy candlestick doesn't tell us the direction, and then very often it might appear on the sideway and they give us a very neutral signal. But if you have this hammer or inverted hammer at the bottom of the trend, so it's like a V shape, and then it appeared in the middle, it often serves us as a bullish trend reversal signal. Okay, so it's very simple as it. And moving on, we call it the hanging man or a shooting star. It's almost like the hammer candlestick, same, have a very short body. It means that the closing price and the opening price, they are very close, like almost no changes. And after that, we have a very long wick on one side and very short wick on the other side. So it's actually just look like a hammer, but the difference between the hammer candlestick and on the hanging man is it appears on the different side of the trend. So normally we see it on the peak of the trend. If let's say we have uptrend for a very long time, maybe like what thing is on maybe like the oil price 2 weeks ago, when oil price traded at like $90. Yeah, and then we see this hanging man, and it might tell us that, oh, maybe potentially they might have a bearish trend reversal coming soon. Okay, if really this happened, and of course we know that now, I think 2 days ago, before the Middle East war occurred, we know that the oil price has actually dropped quite significantly throughout last week. Yep. So it does, yes. On the other side, it just tells us a bearish signal. Okay, for hanging man or shooting star. It's just a name, but what we want to know is how the pattern looks like and what's the logic behind. So imagine this one is like a strong bullish trend for a very long time, and then like holding out for a few days, a few weeks, and then suddenly this appeared. This shows that the market is like in dilemma. They don't know which direction to go, and the bullish momentum seems ease, and the bullish momentum seems like out of control. People like maybe start to have a lot of selling pressure appeared on here. That's why market get it as, oh, the bullish momentum seems to have like vanished or diminished, drastically. So yes, potentially might going down. So it is the same also for shooting star. It's just the direction of the wick is different and the name is different, but the logic behind is the same. It just tells the same thing. It just shows that, oh, the trends might going on another side. And moving on is, we call it morning star and evening star. I would say for just like a single one candlestick for one time frame often tell us different story, and it's also often not so accurate. But for morning star and evening star, for it to have this kind of candlestick pattern, it required 3 candlesticks together. It means that it required 3 time frame. So if this one is like a daily chart, it required 3 days to form this kind of pattern. So on one side for morning star, it is like a trend reversal. It's a bullish trend reversal. It shows that there might be a chance that the trends might rebound from here. We can catch a long position from here, and moving on, we can expect a technical rebound from here. And on the other side, what we call evening star is like, oh, the day is going to over, the sun is getting sunset. That's why we got this evening star. It's often appeared on the peak of the trend. So it is the same. It needed 3 candlesticks. So if like a daily time frame, we needed 3 days to form this evening star. And it gives us the signal that, yes, the bullish momentum maybe has ended. The bullish momentum seems like not strong anymore. There might potentially have a trend reversal. Maybe we can open a short position from here and we can catch the entire trend. So what does it mean and how does it form? So for morning star, previously we will have a very strong bearish trend, means downtrend going down. So we will have this big, very solid, long body bearish candlestick. And then after that, we will have a very short body. It's almost like a doji, short body, short wick or whatsoever. And then this is where, have an alarm. Maybe this is a trend reversal, but we just don't know yet, because just one candlestick, we might, not sure if you are scared to enter the wrong direction. And after that, moving on, we will have another solid bullish candlestick after that. So this solid bullish candlestick have to be more than half a size of the bearish candlestick. It has to be almost the same size with the previous, the first candlestick. You have to be almost the same size with the bearish candlestick. And only if you look like this, only the morning star candlestick pattern is formed. From here, maybe on the fourth candlestick, and then we can enter our position, and then we cross our finger, the trend is reversed, and then we can catch a very nice rebound. It is the same for the evening star. So it's just that the candlestick is different. So for evening star, we can imagine that we have a very good, solid, bullish trend. So it might be like the dollar index for past month. So dollar was strong, or like the oil prices. Oil prices was very strong since July. A very long-term, solid, bullish trend. And after that, after this big, solid, bullish candlestick, come a dodgy candlestick. A very short body, short wick, and then yes, it serves another alert. Say, oh, maybe there's like a trend reversal coming soon. And then of course the next one, the third candlestick, we have this bearish candlestick, very solid, very big body, almost the same size with the bullish candlestick. Yes, and then of course then we can enter on the fourth candlestick. And yes, we hope that the trend is reversed, and then we can catch a nice short position. So I often use this very much, morning star and evening star. And for just like hanging man, shooting star, or just hammer or inverted hammer, it just often serves me as I might be more cautious now. Maybe there's a trend reversal. Maybe there's a chance for me. Maybe there's an opportunity for me to enter a trade. But for me to make sure my trade is correct, my trend is correct, I always look for a pattern like this. It's just to make me to be assured that I entered the correct position. I entered the correct track. Another one that I found very useful is the engulfing. So engulfing is like one is bigger than another. It's just like the name itself is engulf. So we have two different engulfing also. You know it, the bullish engulfing and also the bearish engulfing. So how it appeared is, for the bullish engulfing is after a trend, it's the same after like a bearish trend. After that, we have a shorter bearish candlestick, and after the short bullish bearish candlestick, it appeared, the next candlestick is very big, very solid, very long body, bullish candlestick. It's engulfed. It's like larger than the previous candlestick. So this one serves as a bullish engulfing. But mostly for me, I use it when to decide for me to close a trade. So imagine that you catch a very nice short position, the trend keep going down, and then after that, this appeared, a bullish engulfing candlestick pattern appeared. So this served as an alert for me to say, oh, maybe I shall consider to end my trade here, or to close my position, or maybe I can set my safety pin nearer and whatsoever, right? So normally I will not use it as like a trend reversal signal where I enter a trade. This often serve me as an alarm, an alert to maybe I shall consider to close my position. It is the same for the bearish engulfing. So it is the same. The difference is the sequence of the candlestick. So bearish engulfing is like we enjoy a very solid long-term uptrend, bullish trend going up, and then after that you have a shorter candlestick, a bullish candlestick, green candlestick, you name it. And after that, the next one come with the big solid body, a bearish candlestick. It engulfed the previous candlestick. When this appeared, same, it does tell you that, oh, maybe the bullish trend is over. Maybe the bullish momentum is vanished, is like diminishing, no longer strong. So maybe you might consider to end your trade here, you know, to TP from here, you know, or maybe cut loss from here whatsoever. Just serve is for me, I often use it this way. I don't use it to enter a trade, but I use it when it just tells me that, oh, maybe there's like a trend is changing, maybe I should get out of this trade. Okay, after we learn some of this, after we learn what is candlestick and also some of this very easy but for me I think it's very useful candlestick pattern, moving on we will go for short-term trading strategy. The first one that we want to learn is the breakout. So this strategy involved you, it required you to identify a consolidation range. And of course, after that, you can enter a trade in a direction when it break up, no matter it break up upward or it break up downward. It can be both. So how does it apply is you need to first identify a range. It's like a sideways range. After that, you need to set your entry point. At what extent, you know, towards what point it triggered you to enter a position. And of course, next one, before you set the entry level, at the same time, you also need to think where you should set your take profit point and where you should set your stop loss point, because this is very important. You want to calculate whether this trade is worth for you to enter or not. If the win rate ratio, you know, you are satisfied with it, okay? But often I don't use it because we know if we trade in the market for long, we know that a lot of false breakouts happen. You know, it's like just fool us into a trade and then it suddenly the trend is reversed. So I often don't use it, but only I use it when I want to trade on news and when I want to trade on a very short-term position. I will not use it if I want to trade for like H4, if I want to trade for daily, if I want to do a swing trade. I don't use a breakout strategy. This is only when I'm very confident when like you know, the NFP is going to come out and I'm very confident that yeah, the NFP reading will be very good and I can catch a very nice DXY uptrend, or I can catch a very nice gold price downtrend. This is only where I use a breakout strategy. Yeah, so it's like I say earlier, normally breakout strategy we apply it to trade on news. So these are some of the very famous or important news that for forex trader to trade. The first one, of course, the non-farm payroll, NFP. This is very, very famous. I think every forex traders knows it. And after that, we have to aware of the CPIs, especially the US CPI, because the US CPI will have an impact on the dollar index. And of course, we know that most of the asset pairing will involve in USD. So US CPI is very important. And moving on is interest rate decision. And Canadian feels like Federal Reserve interest rate decision is very important. And then the ECB, European Central Bank interest rate decision, and BOE, Bank of England interest rate decision, and of course BOJ. BOJ, we know they will stick with this ultra loose monetary policy with a negative interest rate. But now, because it's very sensitive, because we are like waiting for the BOJ to say, hey, maybe we want to get rid of it. Maybe we want to increase the interest rate, because we know in the year of 2023, Japan is actually enjoying a very sustainable inflation, which they don't have for the previous like 2 to 3 decades. So yeah, everyone is like waiting for the BOJ to surprise us with their monetary policy, with their interest rate decision. Okay, this is one of those. And also for crude oil inventory. So for crude oil inventory, for the US one, it has like in weekly. So I think every Wednesday or Thursday, we will have this API crude oil inventory or this US crude oil inventory. So if the number come very different from the previous reading or very different from the forecasted number, you can expect to have a very volatile oil prices. Yes, this is what we often use. So I'll just share you like normally how it happen. Okay, first of all, I'll just share with you. This is the hold on, yeah, let me do some. We will just focus on this US economic data, okay? And then from there, maybe we can learn like how we can play along with the news. Okay, now it's like the 1st of September. So 1st of September, the biggest news sure would be the non-farm payroll NFP. And we can see the previous reading was very low and people already forecasted, the market already forecasted an increase. But what happened is the actual number come much higher than the forecasted number, much higher than the previous reading. So when we see higher reading of the NFP, we can expect the dollar to be strong. Okay, so this one is H1. So this one is for you to to show you the clearer picture of what's going to happen when the news came out and the price react towards the news. So at this time, when the dollar the NFP released and the number was good, and it have a positive impact on the DXY, on the dollar index. So if we, and then previously we have this price consolidation range before the news. Okay, remember we have to identify price consolidation range. After that, where should we set a price entry point? It has to be above this range, right? So maybe somewhere around here, like 103.8, maybe we can set a buy stop, order here. And when the NFP reading came out, yes, is favored us, goes up. Yep, and then we enter the trade here. And of course, we need to know where is our TP and where is our stop loss. Maybe stop loss we can set at the end of the price consolidation range. And if we don't, not to be greedy, maybe we just want to earn like 20, 30, 50 pips from this news, we can set a very tight take profit point. Maybe we can refer back to the previous trend. Yep, maybe we can set like about here because we see there's like a pivotal point around here. And yes, this will be a very handsome profit we can make on the news trading. Okay. Let me give you another example. Maybe this September 14, we can see all this green numbering. So it shows that all the number is in favor with the dollar strength. The dollar will be very good, bullish, including the initial jobless claim, including the core retail sales, including the PPI, all are good. It means that there's a chance that the Federal Reserve might going to increase the interest rate. The retail sales is good, the economic is good. Yep. So let's look at what happened on the 14th of September. Yes, again, we found this price consolidation range. Before the economic data was released. We always have to require to identify price consolidation range before we apply the breakout strategy. And then it is the same. We have to set an entry price, entry point above or below this range. If we think, sometimes we can set at two direction. We can catch a long, we can catch a short, but of course this is very dangerous to do But yeah, if you are not familiar with the market and then you really want to trade on news, you already want to try this breakout strategy, but sometimes you can open two sides, above this price consolidation range or below the price consolidation range. But of course, when you got one position, you have to remember to close the other one, or else if you got two position, you will put yourself in dilemma, you will be very confused, and then it might has chance for you to just lose both sides. Okay, this is the same. I don't want to repeat it. It's like a successful breakout, and then we can enjoy a short-term, very short-term breakout strategy. We can make a handsome amount of profit. Okay, but I also want to give you an extreme example, because we know that last Friday, okay, last Friday case is a bit different, it's a bit confusing, and of course it's worth for us to learn from it. So what happened on last Friday? We have a very good non-farm payroll. The non-farm payroll, it was very good. It's like one of the highest level in 2023. Okay, it's higher than the previous reading, it's higher than the forecasted reading. But at the same time, we also have a high unemployment rate. We know that NFP is referring to the labor market. Okay, the unemployment rate is also the same time show that the labor market is not good. Also, we have this declining average hourly earning growth. So the growth for the earning for the workers in the US is declining. So we here we are in the dilemma. We have a mixed result. So let's see what happens on that day. So last Friday, we go to last Friday. Yep. This was last Friday price pattern when those economic data was released. So at first, it does have a very good impact from this non-farm payroll. It stood up, and if let's say we don't set a take profit point, or we don't set a stop loss point, we will not enjoy this big candlestick. We cannot enjoy this shoot up if we don't set up TP, or we do set but we fail to catch this profit. Maybe we are greedy, we set like here, very like further away. Yep. And then after that, after the market digests the economic data, they think that, oh, the unemployment rate is high and the wage growth is slowing down. Yes, maybe the Federal Reserve might consider not to increase interest rate further. Okay, and then after that, yes, you can see what happened. The dollar strength actually softened. So here again, I want to urge that it is very crucial to do the risk management. It always when we enter a trade, remember to set a TP as well as a stop loss point. Back to our slide. Moving on is this pullback strategy. So for me, pullback strategy is more useful because for me, normally I would not be very confident to trade on a breakout, to trade on news, because the risk is greater. You know that what happened last Friday. The risk is big, and we cannot be certain that what's the trend is going to be look like. But pullback strategies allow us to rethink the trend, to make the trend more solid. So it is the same. We have to identify the big trend. We need to know what's the direction of the trend is going to be like. And again, we need to identify the key levels, which is the support and resistance level. And after it appeared, after the price choose a direction, is either a bullish direction or bearish direction, we have to be patient. We wait for a pullback. We don't rush in when it have like a breakout. We don't do that. We wait for a pullback. And after that, when it does have a pullback, we need to confirm the reverse signal. We have to have a pullback. For example, it's like a bullish breakout, it's go up. So we have to wait for a pullback, but the pullback cannot be lower than the previous resistance level. You have to be above it. and then it have we confirm the reversal signal, and we enter from there and catch a bigger trend. So often, sometimes we don't use it for too short term, but we can do swing trade with the pullback strategy as well. And of course, lastly, I need to stress again, we set a nice entry point, and of course, we need to set a stop loss level as well as a TP level. This is also the support and resistance level. We need to train ourselves because everyone will have different TP point, everyone will have different stop loss point. Everyone will see the resistance level differently, everyone will see the support level differently. This is through the experiment. Along the way, if you lose, if you make losses, you just like pay a tuition fees, and then we learn from the market, we learn from our mistake. So I'll give you another example. So let's say from here, okay, maybe I'll just use this tool to show you more, nicely. You can imagine. So this is like the very important resistance point I drew over here. Why you see previously it always rebounded from here. So we know that this point is like a pivotal point for XAU for the gold. And after it broke below, it suddenly here become a resistance level. So the gold price was like suppressed below this range, cannot trade above. Okay. And slowly we see, yep, it touches. But we don't want to be fooled by the market. We don't want to trade in a false breakout. We don't do that. We want to use a pullback strategy. So yep, it does when it go down. When it go down, it show that it's not going to break below this point anymore, this level anymore. We can just enter any point here. This is like a solid pullback strategies already. And we can always set a stop loss, anywhere below this crucial level. We can set it like of course, we don't want to set it very close to this level because sometimes we have like a false breakout also, to make you just stop loss and then the correct trends continue. We don't want to encounter situation like this. And see what happened. Yes, this is a very successful pullback strategies. When you see that it's no longer break below this level and going up, yeah, we can enter anytime from here. Just anytime from here, and then we can enjoy it. And then of course, we need to set TP and also a stop loss. And another one is I want to show you is on October. Okay, again, maybe I'll just show you with this. So just now we have like a bullish trend where we want to catch a bullish trend reversal. This one is another example with a bearish trend. So we know like the big trend is going down. We have the bearish trend. Okay, maybe we fail to catch the trend over here. Here is also like the pullback strategy you can apply here. But sometimes when we are not confident, we know because like previously it's like an uptrend, we are not confident. Maybe here is like a potential rebound. We don't want to catch here, and then we miss the chance. It's okay because we always have chance in the market. We just have to be patient and wait. We don't want to, fears of losing out. We don't do that. And here come another chance. Yes. When it have like a sideways consolidated and then break down, after it break down, then if you see that, or maybe you are not confident to catch this downtrend, we have to wait. And then after we waited here, you see, oh, it cannot break above here. We cannot break above this resistance level. What does this tell us? The trend reversal signal is strong. Is not strong. The bearish momentum is very strong for the gold prices now. We can just enter the position any point here, and we think that yes, the bearish momentum will continue. And yes, it does happen. And of course, we set a TP, we set a stop loss, and we enjoy the profit. Okay. But what happened now? Price consolidated, okay? And maybe there's like a pullback going to happen. This one is like live, you know, this one is like the real time on the 11, okay? So here is the resistance level that we previously drew a line here. So if let's say if cannot break above, come down, yes, maybe we can catch a short position. And what if break above? And break above, if you want to apply a pullback strategy, it has to be break above and then come down, pull back. And if it's sustainable, be above this range, cannot break below, like above this range, we can anytime enter a long position, and we can expect the goal to turn bullish. We can enter a long position after it have, if you want to apply a pullback position, or if you really cannot wait, you want to apply a breakout, you can do so also. You can wait. Okay, it's the same. And also, you just hold on. Remember the previous slide that we are sharing? Here come this what we call a doji candlestick. A doji candlestick is also means that now the market is in the dilemma, but we have another 1 hour for this candlestick to form. So we don't know how this candlestick is going to be. If it just happened to be like this, a doji, what does it tell us? Remember, a doji candlestick on the peak or at the bottom tell us there might be potentially a trend reversal. Okay, so now it's like a short-term uptrend. If we have a doji candlestick here, it might give us a suggestion that yes, a trend reversal might occur, and we can expect a downtrend from here. And of course, if let's say the next one is really a solid, a solid bearish candlestick, a red color candlestick, and this will be the evening star. Evening star appeared, and it is more confirmed that yes, it's a trend reversal pattern, and we can enter a short position from here, and we can expect the gold price to go down. Okay, this is the scenario that it might happen. I'm just discuss with you. Okay, so moving on, the third one that I want to share with you is the range trading. So range trading is like when the market has no direction and we have a long price consolidation range. So if you trade in the market for long, this is what happened with the oil price previously. So last time when we have like the EU sanction on the Russia oil, and then Russia's like try to fight back with the oil supply cut, and the oil price was just like consolidating within the range. So like when we identify such range, we can always do two side. So it's like this. When it touches here, maybe it's a chance for us to enter a short position, and maybe when it touches here, it's potentially for us to enter a long position, and then we can TP here. And after we TP here, then we can think that, oh, maybe it's a chance for us to re-enter a short position, and so on. Because we know that it is like trading sideways in a bigger range. And of course, this one is also a very nice, another nice price consolidation range. You can see the price nicely rebound from this level and always retrace from this level. So we can play within the range. This is what we call ranging. But of course, we need to pay more attention in the market. We need to do a more thorough analysis. We have to confirm that now there's no big news to have an impact on the prices, or regardless it is like an oil price, or regardless it is gold price or the dollar. When there's like the market was quiet and then you really want to trade, and then you identify this range, like a bigger range, and then you think that it's profitable for you, you can can make some profit from it. Yes, you can try arranging, but of course, it is be very wisely to set a TP and SL also, because at any time we have a potential breakout, right? Just now I show you, because after a price consolidation range, what we are afraid is a breakout. So if you don't set a stop loss, if you don't set a TP, and what happened if really the market went to a direction that is in favored us, yes, we might lose out. We might incur a great loss. So we have to be very disciplined also when we trade on the ranging strategy. And of course, we need to continuously monitor. Something gone haywire, something some big news come out, and then some big economic data come out. Someone say something that going to have an impact on the assets that you trade. Yes, then you might have to react very fast. Okay, because ranging is, we want to trade in at a peacetime when the market is quiet. Okay, then only that we trade on the range. We can use the ranging short-term trading strategies. Yeah. Lastly is the risk management. I have been like stressing it for many times. It is very crucial to set a stop loss order, also the take profit order when we open a trade, when you open an order. So it's very simple. You just always play around with the chart. You look at the chart, and then you look at the pivotal point, and then we can see where is the support level, and then where is the resistance level, and after that we can just set accordingly. If you are trading a short, and then where is the stop loss level, where is the TP level. And my advice is we don't always adjust the stop loss and TP level. It often, if you trade in the longer term, it often, is you're going to lose out, I would say, because sometimes we are human, we make mistake. Sometimes when we see the trend is in favor, is in our direction, we will tend to be more greedy and then set our TP higher and higher. And sometimes it haven't touched and you have a trend reversal. We didn't get the TP, we lose all the profit that we supposed to make, and also the stop loss. Sometimes humans is like this. We don't want to lose, we just want to win. So when we have the losses, we just don't want to admit it. We want to set our stop loss lower and lower, and eventually we have the greater and greater losses. We don't want to see that. When we hit the stop loss, we admit it, we learn from the mistake, we learn from the market, we do our review, we can backtest with all different strategies, and then yes, hopefully in the futures we can make more profit. So short-term losses doesn't matter as long as we stick to our discipline, we stick to our very professional entry point, and of course the TP point and stop loss point. So yes, thanks for joining us. Here is the last slide. Of course, we still have some time. I will welcome some of your questions. If I can answer you, I will do so.